Imagine getting a peek behind the curtain, at one of those elite trading desks, where these complex algorithms are just churning through mountains of data, like in real time, making lightning fast decisions. Now, picture those decisions not just for one stock, but for a whole interconnected portfolio. Well, that's exactly what we're diving into today. We're looking at a highly sophisticated pre-market options trading strategy, specifically for September 5th, 2025. And our sources for this, well, they aren't just someone's opinion. These are reports from like a convergence of automated intelligence. We're talking the ultimate options analysis engine, Edge Nexus, Dotus V2.0, and AlphaCore V3.16. Think of them as this super team of analytical systems constantly checking each other's work.
Yeah, it's really fascinating how these different systems, they all seem to line up, to paint this very clear, high conviction picture of the market posture. So our mission today really is to understand exactly how they pinpoint this bullish, risk-on market regime, and then crucially, how they translate that into a precise, actionable strategy across key assets, SPY, TSLA, and a big BTC ETF. We'll dig into not just what they decided, but the why behind it, connecting the dots for you on how these different indicators lead to these really confident trades.
And don't worry if some of these terms sound a bit complex. We're going to guide you through it. We'll try and turn what could be just information overload into those, aha moments. So, okay, let's jump in. Let's set the foundation. What are these systems actually seeing? Right, so for September 5th, 2025, the big picture sentiment from these systems is loud and clear. Bullish, risk on. Now, for a trader, risk on, well, it's not just a throwaway phrase. It basically implies an environment that's like super conducive to aggressive call options because there are these strong, widespread bullish confirmations. It's the system saying, look, the conditions are right, go for upside.
That's a really critical point. And the way they confirm this regime, it's got multiple layers. Our sources talk about perfect bullish alignment across all major assets. So that's SPY, TSLA, the BTC ETF, all of them, together, signaling strong upside. What's really insightful, I think, is that this isn't just, one hot sector or some isolated excitement. It's broad, it's synchronized. That points to systemic tailwinds. This kind of alignment, it's actually pretty rare. And it makes that risk-on call really solid. A significant convergence, suggesting, well, deeply entrenched bullish feeling. And then there's the VIX, the market's so-called fear gauge, right? For this date, it's clocked at 15.3. Now, the systems note this is deep below the 16.5 threshold. A VIX this low, that's a key sign. It signals suppressed market volatility, less fear. The systems interpret this as maximum call bias activated. So if you connect that to the bigger picture, low VIX plus those synchronized bullish signals across different assets, well, that creates a really powerful environment for anyone looking for upside.
Because the market, it's kind of expecting calm seas, which gives more confidence to bullish bets and makes options cheaper.
Huh. That sounds almost too perfect. Is there anything these systems are like actively dismissing or maybe monitoring as potential, minor bumps in the road, things a human trader might still worry about, even with this perfect alignment?
That's a fair question, and yeah, an important one. While the main system bias is definitely strong, those kill switch protocols we'll get to later, they're designed exactly for those unexpected shifts. But right now, the confluence of signals, it's just so overwhelming in their view. The probability of a major, immediate turn is seen as extremely low. The fact that there aren't any significant red flags popping up in their cross-asset checks, that's what's giving them such high conviction for this specific day.
Okay, this next part. This is where it gets really striking for me. One of the biggest surprises from the sources is this dramatic, complete reversal on TSLA. Previously, these same systems had a bear thesis on Tesla, but for September 5th, the message is totally clear. Abandon short thesis. I mean, that's not just a minor adjustment, it's a full 180 turn. The systems are now shouting long bias for TSLA. What specific data, what compelling evidence made them flip like that?
Right, and it's not a gut feeling, This pivot is completely driven by a sequence of very specific, very compelling technical signs. First off, price confirmation. TSLA is at $344.95, up a solid 1.90% pre-market. This shows it can hold that critical $340 plus level we've seen before. And crucially, the price is now above all MAs, all the major moving averages, and also above VWAP, the volume-weighted average price, which is sitting at $344.88. That combination, it signals strong buying interest, broad price acceptance. It suggests a real shift in market psychology.
Okay, so solid price action showing TSLA's moving up. But for a full reversal, I imagine these systems need more, right? Broader confirmation. Like, what about volatility or the underlying market structure?
Absolutely. Beyond just price, the Bollinger Bands are telling a really interesting story here about potential movement. The price right now is testing the upper band. That's at $345.19. The middle band, which is also the 20-day moving average, is at $344.77. And the systems see a squeeze forming, when those bands narrow. That's often a strong indicator that volatility expansion is imminent. It suggests a big price move is coming. And given all the other bullish signals, well, they expect it to be upwards.
Okay, so volatility is building, maybe a big move is coming, but what about the momentum, the actual buyer conviction? Can you walk us through how they figure this isn't just some temporary bounce, but a real sustained shift?
Exactly. And the momentum indicators. They're all lining up for that sustained bullish push. Take the Relative Strength Index, the RSI. It's at 53.05. RSI measures the speed and change of price moves, tells you if something's overbought or oversold. At 53.05, it's pretty much neutral with room to run. That's key. It means buyers still have space to push the price higher before hitting, exhaustion levels. Then there's the MACD moving average convergence divergence. It's at -0.0. MACD shows changes in trend strength, direction, momentum. Here, at -0.0, it's near a bullish crossover. That's a classic signal for a shift from bearish to bullish momentum. The rate of change, ROC, is at +0.04. That clearly shows positive momentum building. And finally, the stochastic indicator. It's at K.85.71. Now, normally that reading might be seen as overbought, but the systems add this qualifier, overbought but strong. And that's a really crucial nuance, right? In strong bull trends, an asset can stay technically overbought for a while. It actually signals sustained, aggressive buying, not necessarily an imminent pullback. Power, not exhaustion.
So it's not just a flash in the pan. There's real power there, a fundamental shift happening. It's almost like these systems have zero ego, just data. They don't stick to a prediction just because it was their prediction. That's a powerful lesson itself.
Totally. It really speaks to their dispassionate agility. And there's more. They see a max volume node between $344.62 and $344.96. That's a price zone where a lot of trading happened previously. It creates a strong support cluster, meaning if the price dips there, buyers are likely waiting. It reinforces the floor. And the order flow, it absolutely confirms this bullish feeling. The bid-ask is 41/7. That indicates a clear bullish bias where buyers are overwhelming sellers. It's concrete evidence of real demand.
Oh, okay. So given this really powerful sudden shift for TSLA, what's the actual game plan? How do these systems translate all this conviction into a practical trade, especially with those aggressive targets?
Well, the strategy is laid out very precisely for a high conviction play. The entry zone for the TSLA calls is tight, $344 to $345. They're specifically aiming for a micro dip to VWAP to get the best possible enter price and the recommended trade. It's either the SEPSOS 345C or the SEPO6 350C. So call options expiring September 6 with strike prices of $345 or $350.
And what are they shooting for, target-wise? And just as important, how are they managing the risk on these pretty aggressive plays?
Yeah, the targets are layered, designed to capture momentum as it builds. T1 is $348, looking for about a plus 20% gain. T2 is $352, aiming for plus 40%. And T3 is up at $355, which lines up with the upper Bollinger Band extension, projecting a pretty substantial plus 60% gain. Risk management is disciplined. There's a stop loss set at $342, just below the 20 EMA. If it hits that, the bullish idea is considered invalid. Key triggers for more upside. A break above $345.19, that upper Bollinger Band, holding above VWAP, $344.88, and a volume spike above 511K to confirm the momentum. Now, about that risk versus opportunity. Yes, the stochastic is technically overbought, but the RSI, as we said, suggests more upside. But here's something particularly compelling. The IV at 0%. Implied volatility is basically at rock bottom. That signals massive expansion potential. The systems actually emphasize that, quote, the IV expansion alone could drive 50% plus gains, even with minimal price movement. So the core insight here is that the market seems to be dramatically underpricing the chance of a big move.
These systems are spotting that disconnect, like a compressed spring, and plan to leverage the expected jump in implied volatility itself, not just the price going up. It's a great example of finding those unique system-driven edges maybe a human eye might miss.
That is fascinating, playing the implied volatility itself for those kinds of potential gains. It really shows a decisive, data-driven approach, completely flipping a stance based purely on incoming data and that precise technical picture. Okay, let's pivot now. Let's talk about the S&P 500 ETF, SPY. The systems see this as the anchor in the portfolio, right? The foundational piece. And for this date, they're calling it breakout confirmed.
Absolutely right. SPY's market posture pre-market is $650.80. That's significant because it's already above the 20, 50, and 200-day moving averages. And it represents a Fibonacci breakout above $649.05. That means it cleared an important technical resistance level based on those historical price ratios, a level lots of big players watch. But what makes this really powerful, the core of the SPY strategy here, is the dealer short gamma 650.
Okay, can you break down dealer short gamma for us? Why is that so critical here?
Sure. So gamma, it basically measures how much an option's price sensitivity, its delta, changes when the underlying stock price moves. When dealers, the market makers handling options trades are short gamma above a certain level, like $650 for SPY, it means that as SPY's price rises, they are basically forced to buy more SPY shares to hedge their own positions and stay neutral. This forced buying, it creates this powerful feedback loop. It can lead to what's called a gamma squeeze. Our sources suggest this could generate an exponential acceleration pattern, maybe with 3-4x normal volume during the breakout. It's kind of like throwing fuel on a fire, right?
Yeah.
It amplifies any upward move, way beyond what normal buying pressure would do.
Wow, yeah, that sounds like a potent self-feeding mechanism. So how do the systems translate that into their main call ladder strategy for SPY? How do they plan to ride that wave?
The entry logic is very specific. Get in only if SPY moves above $649.05 and volume is strong over 75 million shares in the first hour. That confirms the breakout has real participation. The trade itself uses a barbell approach. Two different call options, both expiring September 6th, a 650C and a 652C. Combining strike prices like that helps capture a wider slice of the expected move. Targets are T1 at $653 plus 20%, T2 at $657 plus 40%, and T3 at $660 plus 60%. The stop loss. If SPY drops below $645, that fundamentally breaks the gamma squeeze idea. The systems even identify a gamma density concentration between $653 and $655. That's where the dealer short gamma pressure is likely highest. And they map out the expected breakout triggers, 650.8, then 653, 657, and maybe even 662. It really shows how understanding that market microstructure, like dealer positioning, can be just as vital as your standard technical charts for spotting these potentially explosive moves.
Okay, now for the final piece of the puzzle. The BTC ETF Mini. This one's acting as the gatekeeper and the convexity play, you said. What's its unique role here, and why is it also looking so bullish?
Yeah, the BTC ETF Mini is seen as key for, well, amplifying the whole portfolio's convexity. And it acts as a kind of early signal or gatekeeper for overall risk appetite. Its posture is just as bullish. Spot Bitcoin is around $112.07. The ETF itself is near $49.09. That's important because it's above its 21-day EMA, the exponential moving average. Unlike a simple average, the EMA gives more weight to recent prices, so it signals strong short-term momentum, strong acceptance above that key level. Plus, it's trading in the top 96th percentile of its 30-day range. That indicates really robust performance recently, sustained strength.
And the dealer map for this one, is it a similar squeeze situation, or is there something else these systems are looking at to boost the portfolio?
Yes, similar dynamics but slightly different. The dealer map for BTC shows long gamma support at $110. That means dealers are likely buyers if prices dip to that level, providing a kind of floor. More importantly, there's squeeze risk above 115K. The systems confirm a convexity buy zone above 113K for spot BTC. Now, convexity, think of it like hitting the gas pedal harder on your profits. Normally, gains might grow steadily, right? But in these highly convex zones, the options are set up so that each dollar the underlying moves in your favor can generate exponentially more profit than the dollar before it. It's a key way these systems amplify returns. And that's why BTC is the gatekeeper. It can really turbocharge the portfolio's upside potential quickly.
That sounds like a really powerful way to leverage upside, almost like a supercharger, yeah. So how does that translate into a specific strategy for the BTC ETF Mini?
So the main call ladder strategy for the BTC ETF Mini uses slightly longer dated options SEP19 calls. The entry gets triggered if BTC spot breaks above 113K, which means the ETF itself is trading above $50. The recommended trades are the SEP1950C, that's the primary convexity play, designed for that accelerating profit potential, and also a SEP1951C, which is described as a lotto breakout extension, aiming for even more aggressive upside if the momentum really takes off. Targets here are T1, 50.5 plus 25%, T2, 51.5 plus 50%, and T3 way up at 52.6 plus 90%. Risk management. If spot BTC falls below $110, that breaks the convexity zone. In that case, a contingency hedge, a SEP 1947 put option would kick in, and the calls would be closed. It just shows how these automated systems can seamlessly weave together really diverse assets, traditional stocks like SPY and TSLA and crypto, into one unified strategy where each piece plays a specific role in boosting potential returns.
Okay, so spotting individual opportunities is one thing, but pulling it all together into a working portfolio, that seems like the real trick. How do these systems manage this whole aggressive, high conviction approach? How do they balance that aggression with, being careful?
Exactly. And the overall system bias for September 5th is clearly defined. Bullish risk-on, SPY, BTC, TSLA, all pulling in the same direction. The portfolio shape itself is described as barbell convexity. That's a strategy combining different option types to really maximize potential gains while still having some built-in protection. This whole refined strategy comes from AlphaCore V3.16.
It's really interesting seeing those precise percentage allocations for each asset and still keeping a decent chunk in reserve. What's the thinking behind those specific splits, especially when things feel so aggressive?
Well, the philosophy seems to be about maximum calculated efficiency. Using a baseline of, say, $1,000 in capital, the total exposure is capped at 20%, so $200. That's significant, reflecting the high conviction, but it's not betting the farm. The allocation split is then carefully balanced. It aims to optimize both potential return and diversification within that bullish theme. So 3% for SPY calls, split 2% on the 650C, 1% on the 650C, another 3% for TSLA calls, 2% on 345C, 1% on 350C, and 3% for BTC calls, 2% on 50C, 1% on 51C. And crucially, there's an 11% reserve held back. That's for potential opportunistic adds or maybe unforeseen hedges if things shift. So it's not about blind aggression, right? It's about deploying capital very precisely and keeping flexibility even when you have high conviction.
Okay, so even with those big targets, there are clear rules for taking profits, cutting losses. But what if the market just throws a massive curveball, something none of the indicators saw coming? How do the systems handle those really unexpected, nasty surprises?
Yeah, and that's where the really meticulous risk management layers come in. It reinforces just how calculated this whole approach is. Profit taking is automated, it's scaled. You trim 25% of the position at a plus 15, 25% gain, trim half at plus 30, 40%, hold a smaller runner piece if it hits plus 50%, exit most of it at plus 80%. And for downside protection, the stop-loss protocols are super specific. Certain price levels like SPY below $645, TSLA below $340, or the BTC ETF below $49 trigger automatic trims, down 25%, or even full exits if the loss hits 40%. And for those real curveball scenarios you mentioned, there's even a kill switch. It activates if SPY drops hard below $635 and the VIX simultaneously spikes above $18. If that happens, boom, flatten all long positions. Protect capital. It's like a built-in acknowledgement of potential black swan events, even if they think the probability is low right now.
That level of detail is just, wow. What about hedging against more, let's say, typical market shifts, ones that aren't quite disaster level but still unfavorable? Is that baked in?
It is, yeah. But it's dynamic. With the VIX down at 15.3, showing low volatility, the systems dictate no active hedges are deployed. That shows discipline, right? They only put on hedges when the volatility risk actually warrants the cost and effort. A specific hedge, using UVXY SEP 09 16 calls, that's an option on the volatility index ETF, would only be triggered if the VIX actually climbs to 16.5 or higher. So it's a dynamic defense against rising market fear. And beyond that, the execution timing windows are incredibly precise. They even factor in known macroeconomic events. The systems actually mandate a pre-Fed speech trim, reducing exposure between 11:30 and 11:50 a.m. Eastern, and then going to flat exposure during Fed speech from 11:50 to 12:00 p.m. That shows an amazing level of detailed awareness, even for automated systems, navigating around known potential market movers.
It really sounds like for these systems, going full send doesn't mean being reckless at all. It seems like almost the opposite. How critical is this intense level of risk management and timing when you're aiming for those kinds of aggressive gains?
Oh, it's absolutely paramount. They are blindly aggressive. They're aggressively calculated. The cross-asset effects analysis confirms that perfect bullish alignment. That leads to momentum amplification and convexity stacking. Basically, the individual strengths of each asset start feeding off each other, creating this portfolio-wide acceleration. And these plays are also backed by a mathematical convexity scoring matrix. It quantifies each asset's potential to deliver those accelerating profits. It assigns these really high conviction scores. FPY gets a 9.5 out of 10, TSLA 9.2, BTC 8.8, even the VIX context gets 9.0 out of 10. So yeah, even in this high conviction full send mode, these systems aren't just finding good spots. They're meticulously managing risk, constantly adjusting exposure, factoring in market-wide correlations with incredible precision, and all while keeping that 11% capital reserve just in case, for maximum flexibility.
Well, we've just journeyed through a really fascinating deep dive, haven't we? Looking into this highly sophisticated pre-market options strategy. seeing how these advanced systems, Ultimate, Edge, DOTA's Alpha Core, how they all converge, how they identify and then execute these high conviction trades within that bullish risk-on regime for September 5th, 2025.
Indeed, we saw that big strategic shift in TSLA, that powerful momentum building.
Yeah.
We look at the critical gamma squeeze potential in SPY, driven by that complex dealer positioning, and the strategic convexity play woven in with the BTC ETF. And underneath it all, that intricate dance of capital allocation, super precise risk management rules, even dynamic adjustments for things like a Fed speech. It's really a testament to the power of automated intelligence, isn't it? To analyze without emotion, pivot quickly, and execute with a speed and detail that, well, a human probably couldn't match.
So this deep dive into these fully automated, system-driven trading strategies, it really raises an important question for you, our listener. As these AI-powered engines get more and more sophisticated, better at spotting these nuanced signals, executing complex plans with incredible speed and calculated conviction, what new skills will human traders and investors need to develop just to maintain an edge, or maybe even just keep up, in this rapidly evolving financial landscape? Something to think about.